Fintech Chatter, brought to you by Tier 1 People, leaders in Fintech executive search. Welcome to Fintech Chatter Bitesize. I'm your host, Dexter Cousins, and since launching the podcast in 2019, I've interviewed over 200 Fintech leaders. Without doubt, the coolest thing for me is the feedback I get every day from people who have learned something new from the show. The podcast is a fantastic learning experience for me too. So every week, I take the best insights from guests and put them in a 5-minute listen. Here's Mark Nagy, CEO of Datamesh, and his advice on capital raising and managing investor expectations during a downturn.
And there's two answers to this question. There is the December 2021 onwards answer, which is the time we live in. And there's everything that happened before that when investors were a bit more willing to, back a horse that maybe wasn't quite as bulletproof. So let me go to the first, the pre-December 21 answer, which essentially was investors like you to demonstrate that you're as equally committed to outcomes and financially committed yourself. So not just skin in the game, but you've actually got your own hard-earned in it. So, I personally put everything I had plus, mortgage the house to put some more in, and then, use that money to not fund myself, but to fund others, including funding the build. That's always a good starting point. A fantastic business plan never goes astray. And then what we've done over our rounds of capital raising is we've always linked them to an outcome. So the outcomes have been build, compliance, first transaction, first client contract, first major contract. So each of those things. So you don't have to sit there and say, we're going to do this and we're going to do that. You actually can say to an investor, look, the second trick is in that first paradigm of capital raising is you've got to be brave and get a couple of good, solid strategic investors on from the beginning. In other words, people that are not just putting money in, and I know we hear the dumb money thing, but people are just not putting money in, but they're actually going to get not just financial outcomes of it, but tangible step changes in their business. So when we had the backing of people like the Peregrine Group, who was our foundation customer, and we had some large investors out of Melbourne that were actually backing us as well, like high net worths, knew that they were all going to be instrumental winners of their own outcomes. And then from there, that gave us the gravitas each time. And we've always been very strict that we will only raise enough capital to get us through to the point where we need to go again. And that's very heavily guided us on what outcomes do we need to achieve.
Yeah, I really like that process that you've talked about because time and time again, I see, the big announcement, we've raised X amount, we're going to scale, we're going to grow. And then, I hear from the VC that, hey, we instructed the founders to go and hire a top class CTO and they've hired a chief of staff for dev and a marketing person. And it's kind of there's no clear plan there as to what are we going to do with this money. They get it, they celebrate and then say, oh no, what's the next step, right? So those kind of flags in the sand that you've talked about and they're event-driven, I think is such a good way of positioning it.
No, you're spot on. And look, it gives investors confidence that you're actually it doesn't matter if you're late so much. You want to try and be punctual. The two things investors want to see is they want to see that you're delivering outcomes based on real stories, not BS. That's number one. And number two, that you're not driving the business to run out of cash. But stick to the plan, deliver the outcomes, set the bar low for yourself. Investors don't want you to blue sky them, right? As soon as you blue sky them, you now own that higher bar. You don't deliver, you've created a confidence issue. It's always better to be more conservative. I know this is hard for founders because they typically don't. They feel that they need to impress and really what investors are looking for is confidence and reduced risk and then outcomes on their investment. So post the December 21 era, obviously the world's changed. And, it's all about contracts and it's all about revenue. And they're the only two things that matter. Everything else is secondary. Yeah. And you can the order of those in whatever way you like. The other thing is it's a buyer's market at the moment. So investors have got the opportunity to basically DD the hell out of you and, make sure everything holds water. And I just say to any founder again, make sure you got your story right, have a good data room, try and have your business audited from the get-go. Don't be afraid to have third parties help you on your strategy, and above all else, tell the truth, because the straighter you are with people, the more credibility you get, and that translates immediately into investment dollars, because there's not a lot of great stories around, and we've seen a lot of casualties recently. Valuations have gone through the floor, and people's natural response is to get into defence mode and start talking about things they're going to do. The reality of it is what investors are looking for is good, solid business with good revenue pipelines and good, solid returns and solid management that understands about cost control.
Yeah. Thanks for listening. If you're coming back, thanks so much for your support. If you're new to the show, make sure to follow us and leave a review. And you can connect with me, Dexter Cousins, on LinkedIn and Twitter. This show is presented by Tier 1 People, leaders in Fintech executive search. We find world-class talent to build world-class Fintech ventures, and you can find us at tier1people.com.